Welcome back. I'm John A.G. No, this drop in silver does not automatically mean the story is over. And no, one ugly stretch in gold and silver does not suddenly erase the bigger picture. Because today is not a hype show. It is not a panic show either. This is a positioning show, a pressure test, a reality check. We are going to slow this down, strip out the noise, and answer the only question that matters right now. If silver just got slammed, what comes next? Very quickly, most of you watch these videos and still have not subscribed. If these breakdowns help you at all, support the channel, subscribe, and drop "Our John AG" in the comments so I know you're really here. And by the time you're watching this, the members-only video should already be live with the full update in one place. So if you want the deeper version, join that, and also jump into the WhatsApp channel in the description for the fastest alerts. Now let's get to it. And yes, quick reminder before we go deeper, the March silver giveaway is still live. We are giving away 30 ounces of silver, and if you want to be part of it, make sure you are subscribed, make sure you comment, and make sure you stay active here, because I want the silver to go to somebody who is actually following the work, not somebody who just drifts in once and disappears. A lot of people thought this was supposed to be simple. War risk goes up, oil goes up, fear goes up, stocks wobble, and then gold and silver are supposed to explode in a straight line. That is the story people had in their heads. But markets do not move in straight lines when stress hits. They move in stages. And if you do not understand those stages, you will keep getting emotionally wrecked every time a chart does the opposite of what your gut expected. So let's start there. Why can silver fall right in the middle of a scary global backdrop? Because in the first wave of a real market scare, people do not buy what is smartest. They sell what they can. That is the part almost nobody wants to hear when they are already emotionally committed to the next huge move. When pressure hits portfolios, when leverage starts biting, when other trades are bleeding, when people need collateral, when funds need cash, when traders are trying to stay alive, the first move is often not into a shiny thesis. It is into liquidity. It is into dollars. It is into cash. And that is why you can get these moments where a person says, wait a second, if the world looks more dangerous, why did precious metals just fall instead of rise? Because the first question in a panic is not always, what is my best long-term asset? Sometimes the first question is, what can I sell right now? That is not a broken thesis. That is forced behavior. That is stress. That is the market grabbing people by the collar and saying, forget your beautiful macro theory. Show me your cash. Now, here is where people make the big mistake. They see that forced selling and they treat it like a final verdict. They assume the whole metal story is dead. They assume the bull case was fake. They assume the move is over. And that is exactly where smart positioning can separate from emotional positioning. Because the market can be ugly in the short term and still be right in the long term. Those two things can happen at the same time. In fact, they often do. As of March 27th, spot gold had rebounded to $4,491.78 an ounce, while spot silver had rebounded to $69.54 after a brutal shakeout earlier in the week. That tells you something important. This market is not calm. It is not dead. It is unstable, emotional, and still very much in play. And that is why I want to frame this correctly. This is not a clean trend. This is a battlefield. Not just geopolitically, financially, psychologically, narratively. Every day, one headline pulls traders one way. The next headline drags them somewhere else. Oil rips, then it cools. Gold gets sold, then buyers come back. Silver gets hammered harder than gold because silver is always the drama metal. It is part precious metal, part industrial metal, part momentum trade, part emotional roller coaster. That is silver. And if you are involved in silver, but you do not understand that silver can overreact in both directions, then silver is going to teach you that lesson the hard way. Now let's go deeper, because this is where the real answer starts. The short-term drop does not mean the longer-term reasons for owning metals disappeared. Actually, some of the biggest reasons are still sitting right there. On March 18th, the Federal Reserve left the federal funds rate unchanged at 3.5% to 3.75%, and the Fed explicitly said that developments in the Middle East add uncertainty to the outlook. In other words, even the central bank is openly telling you that the backdrop is less stable right now, not more stable. At the same time, the latest official inflation numbers still show price pressure hanging around. The Consumer Price Index rose 0.3% month over month in February and 2.4% year over year. The latest PCE inflation reading, which is the Fed's preferred gauge, rose 0.3% in January and was up 2.8% from a year earlier, with the next PCE report due on April 9th. Now pause on that, because that matters. If inflation is still sticky, if oil risk is still hanging over the market, if the Fed is not easing, if the geopolitical backdrop is still uncertain, then the environment is still one where capital keeps looking for protection. Maybe not every minute, maybe not in a clean straight line, but the need for protection does not vanish just because silver had a rough week. And this is where a lot of viewers need to calm down and stop thinking in 1-day and 3-day windows. Because one of the worst habits in this market is taking a long-term thesis and judging it by a short-term candle. That is how people get whipsawed. That is how people sell low, then buy back higher. That is how conviction gets replaced by exhaustion. If you are going to deal with gold and silver, especially silver, you need a stronger stomach than that. Now let's bring oil into the conversation, because oil is the bridge between war headlines and everyday life. A lot of viewers hear oil spike and think that only matters for gas prices. It is much bigger than that. Oil runs transportation. Oil hits shipping. Oil affects diesel. Diesel affects trucks. Trucks affect food. Oil and gas also spill into fertilizer, chemicals, production costs, electricity pressure in some areas, and the overall cost structure of moving stuff from one place to another. So when oil jumps, the problem is not only what happens at the pump. The problem is that oil can work its way into the entire system. And that is why people get nervous fast. The Energy Information Administration said Brent was expected to stay above $95 a barrel for the next 2 months if disruptions continue, before potentially falling below $80 in the third quarter if conditions ease. But Reuters also reported Brent settled near $112.57 on March 29th, which shows you how violently this market can reprice when the conflict risk flares up. And here's the part that should get your attention. Reuters also reported that Brent briefly topped $119 last week, and some analysts saw scenarios where oil could move toward $200 if major Iranian export facilities were badly hit. That does not mean $200 oil is guaranteed. It means the range of possible outcomes is far wider than people were comfortable with just a few weeks ago. That is a huge difference, because a normal market says, we have risks. A stressed market says, we no longer trust the range. And when markets stop trusting the range, all kinds of assets start moving differently. That is when people rush to cash. That is when stocks can get pressured. That is when bonds can get weird. That is when gold and silver can first get sold with everything else, then later become attractive again as protection. That sequence matters. Cash first, then reallocation, then renewed conviction. And if you understand that sequence, you stop acting surprised every time the first part happens. Now let's talk directly about silver, because I know a lot of you are not really asking about the whole macro picture. You are asking one thing. Is the silver move broken, or is this just a violent reset before the next leg? That is the real question. And the only honest answer is this. In the near term, silver can absolutely stay wild. It can undershoot, it can overshoot, it can scare people out. It can make bulls look stupid for a week. Then it can rip and make cautious people look stupid the week after that. This is not a market for clean emotions. But the structural backdrop for silver is still not light. The Silver Institute says the silver market is expected to remain in deficit in 2026 for a 6th straight year, with physical investment forecast to rise 20% to a 3-year high of 227 million ounces. The same report also says total supply is expected to rise only modestly, by about 1.5%. That is not nothing. Read that carefully. A 6th straight annual deficit. Physical investment expected to rise. Supply only modestly higher. That does not mean silver must go vertical tomorrow morning, but it does mean the bigger backdrop is not one of comfortable abundance. And when you combine that with macro uncertainty, you get a market that can look disorderly in the short term and still look constructive in the larger frame. That is the part many people miss because they are obsessed with the last red candle. Now compare that with gold. The World Gold Council said total gold demand in 2025, including over-the-counter activity, topped 5,000 tons for the first time ever. It also said global gold ETF holdings grew by 801 tons, while central banks bought 863 tons. That tells you the demand for financial protection and reserve diversification was already massive before this latest wave of stress. So what does that mean in plain English? It means big money was already moving defensively. It means institutions were already treating gold seriously. It means central banks were already acting like trust in the current system is not infinite. And if gold is being treated that way at the institutional level, silver eventually matters too, because silver is where things get more explosive once real momentum returns. But again, the timing is messy. That is the part people hate. They want the thesis and the timing gift-wrapped together. Markets almost never give you both that easily. Now, this is where I want to slow down and say something important to the people who are newer here. Do not mistake volatility for invalidation. Those are not the same thing. A sharp drop can mean fear. A sharp drop can mean liquidation. A sharp drop can mean leverage unwinding. A sharp drop can mean everybody tried to stand in the same doorway at the same time. It does not automatically mean the long-term case failed. And on the flip side, a sharp rally does not automatically mean you were a genius either. You have to stay humble in this market, because silver especially loves humiliating people on both sides. Now, I want to deal with the interest rate argument because a lot of people keep bringing this up. They say if oil stays high and inflation stays warm, maybe rates do not come down. Maybe the Fed stays higher for longer. Maybe that is bad for metals. The first part of that concern is reasonable. Higher inflation can delay cuts. A more nervous Fed can keep policy tighter. Reuters reported this week that the war has shifted inflation risks higher, and that markets have largely stopped pricing in Fed cuts for this year. But here is where lazy thinking kicks in. People then jump from rates may stay higher to metals are finished. That is too simple. History is not that clean. Metals do not move on one variable alone. They move on real rates, trust, inflation expectations, currency confidence, geopolitical fear, financial stress, positioning, and whether people want liquidity right now or protection for later. That is why one headline cannot explain the entire chart, and that is why some of the strongest metals runs in history did not happen in a fantasy world where everything was easy and policy was loose and everybody felt safe. They happened in messy periods, confused periods, inflationary periods, trust-breaking periods, and the word there is trust. That is the center of this whole story. Trust in inflation staying tame. Trust in energy flows staying normal. Trust in central banks managing the landing. Trust in political leaders not escalating things further. Trust in the market's old assumptions. When trust starts cracking, gold usually gets attention first. Then silver, if the move broadens, can get much more violent. That is why I do not think this should be viewed like a neat little one-week trading story. This is bigger than that. Now let's talk about the part of the source material that turns very dramatic very quickly. Because once oil, war, inflation, and shortages enter the conversation, people online always push it one step further. They start talking about total control, rationing, a new system, a reset, a whole new model where ordinary people lose freedom and everything becomes managed from above. And here's my view. You do not need to buy every giant theory on the internet to understand why people are anxious. You do not need to jump from oil is high straight to the world is ending. But you also should not dismiss the emotional reality of what people are feeling. Because when food gets more expensive, when energy gets more expensive, when rates stay high, when assets get volatile, when the news gets darker, and when ordinary families feel squeezed from all sides, it does start to feel like the walls are closing in. That feeling is real, even when the online explanations get exaggerated. So what should you do with that? Simple. Do not let fear make you sloppy. Do not let headlines make you reckless. Do not let every dramatic claim own your nervous system. Stay grounded in what you can actually watch. Price, policy, inflation, oil, supply, demand, liquidity. That is enough. That is already a lot. You do not need 10 conspiracy layers to understand why markets are unstable. The plain version is already serious enough. Now let's bring this back to the investor sitting at home. What should a normal person actually do with all of this? Because that is where a lot of people get stuck. They can follow the argument, they can feel the risk, but they do not know how to translate that into action. So here's the simple version. If you already have a reasonable metals position, you do not need to act like every down week is a personal emergency. You do not need to chase every spike. You do not need to sell every dip. You do not need to refresh the chart every 9 minutes. You need discipline. If you do not have a metals position at all, then this is where people need to be honest with themselves. Waiting for perfect calm before building protection usually means you wait too long. Because when the setup becomes obvious to everybody, the price is rarely kind. That is why gradual buying matters. Not emotional all-in buying, gradual buying. Measured buying, position building, and yes, cash matters too. I know some people hate hearing that because they want a one-asset religion, but cash gives you breathing room. Cash stops you from becoming a forced seller at the worst possible moment. Cash lets you survive volatility. Cash lets you buy when panic creates opportunity. So no, I do not think the smart move is to be blindly all in on one thing just because you are angry at the system. Anger is not a portfolio strategy. Preparation is. And that is where disciplined metals buyers tend to do better than emotional headline chasers. They understand that the dip can be painful and still useful. They understand that protection is not supposed to feel exciting every single day. They understand that insurance is often boring until the moment it matters. And that is exactly why most people under-own protection, because they only want it after the damage is obvious. Now let me say something directly to the silver stackers, because I know some of you are hurting after this swing. Do not let one pullback turn you into a permanent pessimist. Silver has always punished weak conviction. It did that before social media. It did that before this conflict. It did that before the latest macro panic. And it will keep doing that. Because silver is not a smooth asset. It is a test. It tests patience. It tests sizing. It tests whether you actually believed your thesis or whether you just liked it when the candles were green. And some of the best silver opportunities never felt comfortable in real time. That is the truth. Comfort is usually available at the wrong price. Now, does that mean go out and bet the house on silver tonight? No, that is not what I am saying. I am saying understand the difference between turbulence and collapse. Understand the difference between a washout and a broken structure. Understand the difference between people selling because they changed their mind and people selling because they need cash. Those are not the same thing. And if you cannot tell the difference, you will keep reacting to the wrong signal. Now let's talk about the path from here, because that is what everybody wants. What happens next? I think there are really three broad paths. The first path is de-escalation. If the conflict cools, if oil backs off, if the panic trade unwinds, then the first reaction could be relief across risk assets. But do not automatically assume that is bearish for metals. Sometimes when the liquidation pressure lifts, money rotates back into gold and silver because the forced selling phase is over. That is why good news can still end up helping metals after a bad stretch. The second path is prolonged tension. If the conflict drags on, if shipping risk stays elevated, if oil remains heavy, if inflation stays stubborn, and if the Fed stays trapped, then the case for monetary hedges stays alive. That path is messy, but it keeps the macro reasons for owning metals on the table. The third path is the most annoying one, chop. A hard, emotional, frustrating digestion where silver swings, gold stabilizes, oil stays headline-driven, and nobody gets the clean breakout they want right away. And honestly, that third path is the one that usually does the most psychological damage because it wears people down. Not with one giant move, with repeated doubt, with repeated fake-outs, with the feeling that the market is specifically targeting your patience. And sometimes that is exactly the kind of phase that sets up the next stronger move later. So the key is not pretending to know every candle in advance. The key is staying aligned with the backdrop while respecting the volatility. That is how serious people navigate this. Now I want to say something about virality and noise, because this topic has become a magnet for overstatement. When silver drops, half the internet says it is over. When silver jumps, the other half says the system is collapsing tomorrow morning. Both sides usually get more clicks than clarity. That is why I want you to stay careful about who you listen to. Anybody can scream. Anybody can attach a dramatic thumbnail to a chart. Anybody can turn a messy market into a certainty machine. Real analysis is slower than that. Real analysis says, yes, the short-term pain is real. Yes, the long-term case can still survive. Yes, oil matters. Yes, policy matters. Yes, liquidity matters. Yes, silver deficits matter. And yes, timing is still hard. That is closer to reality than the extreme versions. And if that sounds less emotionally satisfying, good. Reality usually is. Now let me put a very practical frame around silver versus gold, because this helps a lot of people. Gold is usually the cleaner fear hedge. Silver is the faster, messier, more unstable cousin. Gold often gets institutional respect first. Silver often gets retail excitement later. Gold can absorb large flows more smoothly. Silver can feel like it wants to tear your face off in both directions. So if you are holding silver, you should expect more emotional violence than if you are holding gold. That does not make silver bad. It just means silver demands better sizing and a stronger head. And this is exactly why I keep saying this is not a game for weak position management. If your position is so large that every 5% move ruins your day, your position is too large. That is not conviction. That is bad sizing. Now, another thing people need to watch is not just whether prices bounce, but how they bounce. Do buyers step in quickly? Does silver recover ground with force or with hesitation? Does gold lead first? Does oil cool while metals stabilize? Do inflation expectations keep creeping higher? Do physical buyers stay active? That is what I am watching. Not just one number, the behavior around the number. Because behavior tells you whether this was simply a flush or whether the market is still fragile underneath. And remember, the market does not have to become pretty for the thesis to stay alive. It just has to keep proving that demand returns when fear stops forcing people to raise cash. That is the key. And right now, the rebound in late March tells you there are still buyers here. Not passive observers, buyers. Now, I also want to bring in the human side because this channel is not only about charts. If you are someone who has actually built something in a hard environment, if you have protected your family, grown a business, made smart moves when everyone else was losing their head, share that in the comments once in a while. A lot of people reading these comments are trying to stay focused, and success stories from real viewers do more for morale than fake motivation ever could. And while you are down there, tell me this. Do you think this silver flush is a reset before the next leg, or do you think this market needs much more time to cool off? And second, if you were putting fresh money to work right here, would you lean more toward cash, more toward gold, or more toward silver? I really want to know where you stand, because that split right there tells me a lot about sentiment. Now back to the big picture. The reason this topic has so much emotional power is simple. It is not just about metal. It is about confidence. Confidence in money. Confidence in policy.
Confidence in supply chains. Confidence in energy. Confidence in what tomorrow costs compared with today. That is why gold and silver pull people in during moments like this. They are not just commodities to many people. They are symbols. They represent a way to step partially outside the promises of the system. And when the system looks less stable, those symbols matter more, not less. That does not mean every buyer becomes right immediately. It means the demand for an alternative store of value keeps coming back. Now here is a point that almost nobody explains simply enough. Silver can be right later and still hurt you now. That is the truth. So stop building strategies that only work if the market validates you instantly. Build strategies that can survive delay, that can survive a shakeout, that can survive embarrassment. Because markets love embarrassing people before rewarding patience. Now, if oil keeps staying hot, if inflation refuses to fade, if the Fed stays pinned, and if geopolitical risk remains elevated, then I have a hard time believing the need for hard asset protection just disappears. Could it get messier first? Yes. Could silver overshoot lower before the next stronger move? Yes. Could gold outperform silver for a while before silver catches up? Yes. All of that is possible, but that is different from saying the case is gone. I do not think the case is gone. I think the market is trying to shake out weak hands, reset expectations, and force people to choose between reaction and discipline. And that decision matters more than any one headline. Now let me also touch the common person angle, because you asked for this to be simple enough that anybody can follow. So here it is in very plain language. If the world gets more dangerous, markets can first sell everything to get cash. After that first wave, people usually go looking for safer places again. Gold usually gets attention first. Silver can follow, but silver is more emotional and more volatile. High oil can make inflation worse. Sticky inflation can keep rates higher. That can hurt risk assets. It can also keep the case for protection alive. Silver still has a supply-demand backdrop that is tighter than many people realize. That does not guarantee a straight move up. It does mean this is not just a random dead asset. That is the plain version. And if you can hold on to that simple framework, you will make much better decisions than the person who changes their worldview every 48 hours. Now, before I close, let me say this. By the time you're hearing this, the members-only video should already be up with the full update in one place, including the extra detail we cannot always fit into the public video. If you want the deeper work and the premium analysis, join that. And for the quickest alerts when things move fast, join the WhatsApp channel as well, because when these markets get violent, speed matters. Also, if you are getting value from these videos and you still have not subscribed, fix that today. I see the stats. A huge number of people watch, take the information, and leave without subscribing. If you genuinely value the work, support the channel, subscribe, and leave a comment. Even if all you write is RJohn AG. That small action helps more than you think. And one more thing before I land this. If you have been successful, if you have made it through difficult cycles, if you have learned how to stay calm while other people panic, share a little of that in the comments. Somebody reading your comment might need that perspective today. So where do I land on the main question? Silver price meltdown. What's next? My answer is this. I do not think the recent drop by itself proves the story is over. I think it proves stress is real. I think it proves liquidity still matters. I think it proves silver remains a violent market. I think it proves oil and geopolitics can shake every chart on the screen. And I think it proves that if you are going to be in the space, you need patience, cash discipline, and a clear understanding of the difference between a thesis breaking and a market simply panicking. The next move will not be decided by one emotional post, one dramatic thumbnail, or one trading session. It will be decided by whether forced selling fades, whether inflation pressure remains, whether oil stays elevated, whether trust keeps weakening, and whether physical demand continues to matter more than people think. That is what I am watching. That is what should matter to you. Not the noise, not the screaming, not the daily overreaction. The real drivers. Because if you can stay focused on the real drivers, then even when silver gets ugly, you do not have to get lost with it. And that is the whole game right now. Stay sharp, stay measured, stay hard to shake out, and keep your eyes on what this market is telling you under the panic, not just on the panic itself.